All right, looks like it's 10 o'clock. We got a pretty decent number of people. It's continuing to grow. Just want to make sure that everybody is able to hear me and see the presentation that's being shared with you. If you do not hear me, you can adjust your audio by clicking on More at the top of the window, choose Settings, then Device Settings, and use the drop-down menu to make whatever changes you need. For any questions that you might have, use the chat option at the top of your screen. And if you haven't already done so, it is also placed in the chat. The steps in order to get your CPE for today is at the top of your Teams webinar window. Click on Conferences IO button, and then complete the check-in form, then click Check-in Now. When the poll is open, it will be displayed automatically on your screen. Click the circle button next to the answer of your choice, then click Submit. Poll results will be displayed in real time. Once we're done with our session at the end of today, or if you leave early, make sure you click the checkout. Some information, this presentation is intended for general educational and/or informational purposes only and does not replace specific independent professional advice. This presentation is based on our current interpretations of the law. These interpretations may ultimately, after further IRS or other guidance, be changed. Statements and opinions expressed are those of the presenter or participants individually, and unless expressly stated to the contrary, are not the opinion or position of the Bonadeo and Company, LLP. Bonadeo and Company, LLP assumes no responsibility for the content, accuracy, or completeness of the information presented. Attendees should note that sessions may be audio recorded and published in various media, including print, audio, and video formats without further notice. All right, so good morning. My name is Paula Santiago, and I'm one of the directors here at Beacon Solutions Group, a division of the Bonadeo Group. And co-presenting with me today is Beacon COO, Andrea Hagen. Thank you for joining us for our annual tax-exempt webinar series. We will be presenting on Deciphering Your Dashboard, designed for medical practices and entities. So I'm certain that you will quickly realize that Andrea and I are pretty informal people, and we like to have fun with our presentation. So feel free to enter any of your questions in the chat box as they come to mind. We will be monitoring the chat, and if we miss any along the way, don't worry, there will be an opportunity at the end to answer and ask any questions that you might have. A few housekeeping items. The presentation materials and links to the webinars replays will be sent to you via email within 2 weeks after the event concludes. If you haven't registered for the remaining sessions yet, there's still time. You can either visit bonadeo.com and search for tax exempt webinar series to sign up, or the link, look at that, she's ahead of the game. The link will be placed in the chat box for you to use quickly. All right, so we're going to begin the presentation by introducing the concept of revenue cycle KPIs, how they can be used to improve the financial health of your practice or entity by delving into the key metrics used in the revenue cycle KPI dashboard and explaining how they can be used to optimize your billing process. During this session, we will also help you understand how to interpret those metrics presented in the KPI dashboard and how to use this information to improve your practice or entity's financial health. Finally, we will discuss strategies that you can implement to improve your revenue cycle metrics and optimize your medical billing process. Managing the revenue cycle has become increasingly more difficult, but failure to consider the entire cycle will lead to a revenue cycle that is not optimized or at best practice. All right, so sit back, relax, sip on your drink of choice. Oh, wait, for a minute there, I forgot this was a work presentation. I meant to say caffeine drink of choice. And let us introduce you to revenue cycle KPIs. Revenue cycle KPIs are the metrics used to measure financial performance, providing insight into the operational efficiency of the revenue cycle process. Operational efficiency helps us to identify areas of improvement by providing insight into the operational efficiency of the revenue cycle process within your practice practice or entity. Wow, I'm tongue-tied today. A healthcare provider revenue cycle KPI dashboard is a tool that provides an overall view of revenue cycle KPIs, making it easier to monitor and manage financial performance of your practice or entity. All right, so let's look at this is a sample KPI dashboard. And while there are a lot of KPIs listed on this sample dashboard, rest assured we will further explain how to calculate these KPIs, strategies to obtain best practice later in our presentation. But I did want to take a few minutes to point out a few KPIs and things to consider when reviewing your dashboard. First, when looking at your AR percentage greater than 90 days, this should be less than 25%. But keep in mind that if your practice or entity is a Medicaid-only entity, you should track your AR percentage greater than 120 days, but this should still be less than 25%. While days in AR should be 20 to 35 days or less based on the specialty of your practice. Credit balances should be reviewed monthly and resolved within 60 days of identification. Keep in mind that this 60-day rule is a federal and state requirement also, and I'm pretty sure none of us look really great in orange. Denials and rejections should be less than 5%, and your entity may want to consider splitting rejections and denials based on the practice's problem areas, like you see on our sample dashboard here. And while you might start off only tracking denials, you may quickly realize that tracking rejections is also important for your practice or entity's trends and root cause analysis. Some things to keep in mind as you start to build your KPI dashboard and review it on a monthly basis, because what's the point in a KPI dashboard if you're not going to look at it? Low charges will impact your AR percentage, and low claims volume will definitely impact your denial percentage. Any increases in write-offs will lower your AR percentage, but it's not going to be a true reflection of your revenue cycle efficiency. Any extra payments received in a month due to timing of payment cycles could impact your monthly KPI numbers. Every month, I'll say that again, every month, you should look at your numbers and do an analysis to ensure you understand why the numbers are what they are. You don't want to report anything on your dashboard you can't explain, because otherwise there will always be questions you can't answer. If there are variances, however, you should add a script or a footer with the explanation of why, and if there are variances that you know are not concerning, indicate that reasoning also. The dashboard and the analysis should always be a team approach to ensure its success. Keep in mind that some of these KPIs may not apply to all practices or entities, and each practice or entity should create their dashboard based on what is important to them. And just because, yeah, go ahead.
I was going to ask you a question, Paula. Like, where would people think that they would be able to get some of this data?
Yeah, so there's going to be many different areas depending on the practice management system, billing system that they utilize. They might be able to run reports out of there. There are clearinghouses. A lot of clearinghouses have built-in reporting systems. And there are some data analytics software out there that do have the possibility of grabbing data out of systems and being able to produce these numbers as well. And if not, then there might be some manual, like Excel tracking that will need to occur. I think it'll become very apparent to individuals once they see how to calculate each of these areas. Sorry. They'll be able to see whether or not their system has that capability. And if they don't know, they'll be able to ask the right person at their organization.
And I suppose there's always the opportunity if the systems aren't getting you what you really want or that you need, you can go to them and ask for enhancements too.
Correct.
Because if you want it, somebody probably else wants that same data as well.
I would agree with that statement. All right. Oh, look at that. We have our first poll question. That should be popping up for you here. Does your organization utilize a revenue cycle KPI dashboard? Well, we're about 50-50 there. All right, so between the no's and the I don't knows, that percentage is a little bit higher. Um, Again, I know that we've got a wide variety of individuals in here. Not all are going to be medical practices, so that might skew our numbers a little bit as well. All right, so now that we've answered that poll, Andrea will begin presenting on key metrics and how to calculate them.
Perfect. Alrighty.
There is a question. Sorry, Andrea, there's a question in here from Linda. How do I see the presentation? It should be sharing automatically for you. Cian, do you have any other suggestions for her if she's not seeing it?
Yes, I'll help her in the chat. You can continue with your
Thank you.
presentation.
Perfect.
Great, thanks. Alrighty, so first I want to start with saying that there aren't really any industry KPIs for charge, payment, and contractual adjustment amounts. Those were on the dashboard that we presented, but there aren't any KPIs for that. But you still have to pay attention to them because we need to treat them as internal data points that at least should still be monitored. Variations in charges and payments and contractual allowances, they may be indicative of revenue cycle problems, such as maybe a provider failing to complete their documentation and getting charges submitted, or claims not actually being submitted out of your billing system to the payers. Remittances and payments maybe aren't getting posted, and that's going to show some variations in those numbers. Also, maybe payer retractions that lowered payments and you weren't really expecting that. So unanticipated results should be analyzed quickly to ensure any potential issues get resolved quickly. Now, when we look specifically at the gross and net collection ratios, those are based on charge and payment data, and therefore variations in those data points are going to impact these particular ratios. And the ratios show the percent of charges that are collected from patients and or insurance companies. A higher GCR or NCR is generally a positive sign. You want high numbers, and it indicates that your organization is collecting a higher percentage of its charges. Now, some people say that the GCR is really not a good indicator of actual payments made, and that the NCR is more telling. You see, the GCR doesn't factor in write-offs and other similar adjustments, but the NCR does. So since the NCR factors in contractual allowances, it measures how well a practice collects all legitimate forms of revenue. Now, I have to say days in AR is probably my favorite KPI. It tells so much, and it's such a great indicator of how things are going within your revenue cycle. And what it does, it measures the average number of days it takes to collect payments from patients and or insurance companies. There are industry standards that have been created that represent nearly every provider type that you can imagine, and these can be used to determine how well you compare then to your competitors and colleagues. Although benchmarks may vary somewhat, the industry-wide average is somewhere between 20 and 35 days. Now, the range may seem kind of large, but really when you consider the differences in provider types and payer mixes and services and billing requirements, that range really is reasonable. A physician practice that's comprised mostly of HMO and Medicare patients, and they will more than likely submit their claims electronically at least a few times each week, and they're going to receive their payments back in about 14 days. After allowing a couple of days for payment posting and other in-office tasks to get completed, Most accounts will be cleared within 20 days. Alternatively, a provider type that's required to submit their claims on a monthly basis will have many more days added to their billing cycle alone. So dates of service rendered at the beginning of the month, but not actually billed until the following month, they're clearly going to result in a higher days in accounts receivable. I would say it is worth noting that days in AR should be calculated using the date of service, not the billing date. Many billing systems allow the user to determine what date they want to use for this metric. So unless claims are submitted on the date of service using the bill date, it will always result in a lower days in AR. And then every time a claim is resubmitted or rebilled, the system will start that calculation all over. So, we've gone in and seen many practices where they're running then looking at their days in AR based upon bill date. And it looks like they have, 90% of their aging is in the current bucket. But then when you really look at it, you discover, no, they just keep hitting resubmit, 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 and their aging is really in a bad situation. So again, another example, so a service that gets rendered on January 2nd, but billed on the 30th, that's already 28 days old right there. But if the billing date is used, it will appear as 0 days outstanding. And if that same service then needs to get rebilled 15 days later, we're now at 43 days, but under the billing date methodology, it's going to reset to being at 0 days outstanding. So using the billing date, that also can result in untimely filing issues, as claims could really be in that 90 plus aging category, but appear on the aging report as being current. Remember, payers utilize date of service, not the bill date, when they are applying their timely filing rules. My next favorite KPI is the percentage of AR greater than 90 days. The industry-wide benchmark states that receivables greater than 90 days should represent less than 25% of the entire accounts receivable. When the percentage exceeds 25%, you should do some digging into your AR to figure out what might be going on. That next step in the investigation process should be narrowing down which payers are causing the elevated percentage, and then determining if there is a problem with those outlying payers. Maybe it makes sense, but maybe there's an issue. Perhaps, they are well-known slow payers, maybe like the VA in certain situations. And there's just nothing that you're going to be able to do about that. Maybe you discover that several large remittances never got posted. Maybe you learn that your billing team hasn't been following up on denied claims. Maybe you realize that your private pay accounts are not being transferred to collections or attorneys and are remaining in that private pay financial class, and thereby negatively impacting the percentage. Now, I always described contractual allowances as being the cost of doing business with insurance companies. It's the difference between your charge amount and then the payer allowed amount. And it's in that amount it's the amount that a participating provider is never going to get paid. Now, conversely, write-offs, they represent lost money, and many write-offs are preventable. While everyone knows that nobody is perfect and no practice is perfect, write-offs should still be less than 5% of overall expected collections. Each practice should have a written policy that includes creating a write-off log that lists all claims and that the billing team is suggesting need to be written off. And it should include the reason or the root cause, as well as the dollar amount to be written off. And there should be an approval process, which includes somebody else, a secondary person, preferably someone higher than the billing team that are putting these accounts on the write-off log. Somebody else should be reviewing and approving those accounts before they get adjusted off the billing system. Additionally, your write-offs, they should be analyzed monthly to identify the root causes so that process improvements can be implemented across the revenue cycle as needed to prevent future write-offs from occurring. Now, credit balances, they represent the amount that has been collected that is more than your entitled amount. Credits need to be reviewed on a regular basis as they are not only a revenue cycle concern, but as Paula mentioned, they are subject to state and federal requirements and regulations. Credit balances really should represent somewhere or no more than 5%, but 1 to 5% of the total gross AR, and should generally be found in the more current aging categories. It's an indication that you're working them that way if they're in the more current buckets. Credit balances that are greater than 6 months old, they could indicate a failure to meet the regulatory requirements. We recommend that each practice have a written policy to review and resolve credit balances within 60 days of identification. If a practice is unable to refund money to a payer or a patient or a guarantor, the money needs to be turned over to the state using the unclaimed funds process. And here, at least in New York, we provided you with the website address to be able to get information on that unclaimed fund process. Private pay statements are unfortunately really common within the revenue cycle. While practices and clinics, they should always try to collect all private pay balances at the time of service, there are times when that simply is not going to be possible. There's no KPIs available for statements, but monitoring when statements are generated and mailed and the number of statements in each cycle does have a lot of value. Statements should be sent at least monthly, and depending on the provider type and the volume of statements, alternative statement cycles may end up being considered best practice. Statements are expensive. If you think about paper, envelopes, postage, and then the time that it takes your staff to look at them and to print them and to fold them and to stuff them and to stick the stamps on them, all of that. But they're also costly because there's an increased risk of bad debt. In the medical world, providers have a 70% chance of receiving payment at the time of service if they request it, but they only have a 30% chance of collecting after a patient leaves. Paula, you're muted.
I knew I was going to do that. In 2025, we're still forgetting to unmute ourselves. All right, so now we're going to talk about denials and rejections. Denials definitely need to have a team approach to identify the root cause of your rejections or denials and ways to eliminate or minimize them. Denials and rejections measure the percentage of claims that are rejected or denied by your insurance company. A low denial percentage indicates that a practice has good coding and billing processes, which positively will impact your revenue. To calculate the denial percentage, you will divide your total claims for the month by the total denied claims for the month and multiply that by 100. As we talked about previously, best practice is that your denials and rejections should be less than 5%. Keeping in mind, like we talked about a little while ago, not all practice management systems and clearinghouses will allow for reporting on denials. So if your system does not, you may have to develop a way to keep track of your denial dates, your cart code received, and quantity in order to track and monitor this KPI. All right, poll question number 2 should be popping up for you in your conferences IO. Does your organization have a denial management program to identify root causes? Yes, no, I don't know. Oh, look at that. We're right about that 50-50 mark. We've got 37%, 38, 39. Oh, we're getting higher. All right. Move along here. So while there really isn't an industry KPI for billing dates, it is still important to monitor that the billing dates are occurring consistently based on the practice or entity's needs. You want to monitor to ensure that the practice or entity is consistently generating and submitting claims according to internal policy and payer payment cycles. For
Hey, Paula.
example,
Oh,
yeah.
I was going to jump in and say something. I was thinking about, like some payers, if they're doing that monthly billings process and they have to bill in the following month, if, by not getting claims submitted maybe by the 14th of the month or the 15th, you're not going to end up getting payment then until the following month thereafter. So I think billing cycle, like you said, looking at the dates and monitoring them, but for some, it's really important to meet those billing cycle target dates.
Absolutely. Absolutely. And one of the examples that I wanted to just point out is that here in New York, if your claims are submitted to Medicaid by noon on Wednesday, they are generally paid in the next payment cycle as long as they're clean. So if you don't hit those payment cycle windows, you could result in missing out on a Medicaid payment cycle check. So consistent submission of your claims allow payments in a timely manner, which help to improve your cash flow and reduce risk of denials and obviously minimize your write-offs for timely filing. Each entity should decide what its policy is going to be on claim submission. While some organizations can bill on a monthly basis or even required to, depending on their facility type, other organizations should consider billing 1 to 2 times per week. And again, this billing schedule should be included in your organization's billing policy, procedure, and workflow, but it is completely up to the practice and entity to decide what they think is best for their practice and entity. Just like with the billing date, the closing date really isn't an industry KPI either. But month-end close and consistent month-end close process is critical to your revenue cycle. Monitoring these dates will ensure that your practice is consistently following a month-end close process. Consistent month-end close allows the practice to reconcile and report on their monthly charges, payments, and adjustments. As part of the month-end close, you should be reviewing, documenting, and reconciling all your financial transactions, comparing your bank account transactions to accounting book entries, and also against what is reported in your practice management system. I will tell you there's been many times when we've been out in the field doing operations reviews or reconciliations or billing assistance where we'll look at what is on the general ledger compared to what's in the billing, and those numbers do not match. It's really hard for the organization to have a handle of what is going on with their organization if the systems are not matching. You'll also want to reconcile your credit card transaction. And lastly, of course, reviewing your KPI dashboard, because that should be part of your monthly process. All right, so now that we have talked about the key metrics, Andrea will kick us off with strategies to improve our revenue cycle metrics. If you're not currently a best practice, here's what you will learn.
Okay, great. So you can improve your net collection rate in several ways. One way is to collect more at the time of service, identifying co-payments and calculating co-insurance amounts and attempting to determine whether deductibles have been met, and then asking for the payment. And making sure that your staff are not saying, would you like to make your payment today? Seriously, we all know the answer. No, nobody wants to make their payment today. But instead, changing the script that they use to say, I see you have a co-payment of X dollars amount. How would you like to pay that today? We accept cash, check, and credit card, for example. And I would say over the years, Paula and I being out in the field, we've seen that many more practices and provider types are getting much better at being more forward in how they are asking for payment, because it becomes so clear how important these self-pay payments are to the financial success of medical providers. Now, assessing a billing fee may also provide some additional encouragement to someone who's somewhat hesitant to make the payment at the time of service. It has been confirmed and determined that it costs anywhere from $15 to $30 every time you have to generate a patient statement. So adding a billing fee that at least covers your costs certainly is reasonable. And what I've seen overall is that $25 seemed to be that common billing fee that gets assessed when a patient doesn't pay at the time of service and a statement needs to be sent out by a medical provider. Now, a second way to improve the NCR is simply just to be aware of it and to be able to monitor it. Ignorance may be bliss, but it doesn't help you when you're trying to collect every possible penny. And then lastly, you could consider partnering with a revenue cycle expert who can review your processes and identify where you have leakage and missed opportunities for collecting revenue. Now, improving days in AR, that can be achieved by focusing on both front and back office duties. The responsibilities assigned to the front end staff dramatically impact the revenue cycle. A business-like approach that includes verification of insurance, the accurate entry of demographic information, determining and collecting patient liability amounts, and obtaining prior authorizations needs to be part of that front office, front end revenue cycle culture. Revenue cycle experts, we love to say garbage in, garbage out when we discuss the front office, but it really, really is an accurate statement, as a large amount of back office processes hinge on those front office tasks. And if the back office is constantly spinning its wheels trying to fix or to make up for deficits from the front end, they really can't focus on the important back office tasks of billing claims and then fighting the insurance companies. The back office needs to make sure that they're working claim denials. On average, up to 20% of revenue is lost due to denials and the failure to work denied claims. And Paula's going to dig into denials in a little while and give some more detail on that. Accounts receivable reports should be generated and analyzed at least monthly. Now, your billing staff, they may need to review AR reports on a weekly basis, or maybe they're going to review them after payment posting. But for sure, someone from your management team should be looking for trends and fluctuations at least monthly. So, for example, if you see growth from one month to the next in a particular aging bucket, someone really needs to look into that to see why the amount increased. Is there a specific payer that has rolled a large AR balance from the 60-day category over into the 90-day aging category? Did a remittance not get posted? Did claims get rejected and never got rebilled? Is there an enrollment issue with a particular payer? Those are the kinds of questions that need to be asked when looking for what is happening in those aging categories. Now, a lot of billers, they don't like to post denials or zero payments. If you're utilizing electronic payment posting functionality within your billing system, and it's available in most medical billing systems, there really is no reason not to post zero payments and the associated denial codes that go along with those. Now, if someone, on the other hand, is manually posting all of your payments, it certainly would be easier to understand their reluctance, since it can be very time-consuming to post zero payments. Now,
Keep in mind also, sorry, Andrea.
yes.
Keep in mind also, if your organization is not posting zeros and denial codes, you will not be able to report on that denial KPI because you won't have any information loaded into your system, even if your system has the capability of running those reports.
Right on. Absolutely. I will say that best practice, best practices, it supports posting all payments, including non-payments, within 5 business days of receipt of that remittance. The faster you post the payments, the faster that account is going to get to a zero balance, which results in a lower days in AR. And then also by posting those zero payments, the biller will be able to have the information that they need right there within the system to determine what their next follow-up action needs to be. And they can work that denial much quicker. And keeping somebody in their desk and not hopping up to look at a remittance somewhere, that saves time. And again, just not having maybe to log into different payer websites to pull up the information for zero payments. Get it in your system. All right. Let's see, strategies for lowering the percentage of aging greater than 90 days. Some of those ideas. So implementing standardized and rigorous follow-up procedures. Your staff should have a clear understanding of the order of priority for aged receivables that you expect them to follow up on. Focus should be on accounts nearing timely filing rules and those with higher balances. The value of providing your billing staff with general training and system training. It can't be understated. Newly hired staff should be thoroughly oriented to your revenue cycle processes. Just because you bring somebody on board and they have been a biller for 5 years, it doesn't mean that they were a good biller. You have no idea if they were previously taught inaccurate things, or if their previous employer had efficient processes. And you may have frankly just hired a hot mess who doesn't even realize that they're a hot mess, and they're now poised to turn your revenue cycle into a hot mess. So train those new folks, make sure they are going to do things the way you want them to be done. So going along with training with your system as well, you need to ensure that you're effectively utilizing as much of the available system functionality that you can. If there are time-saving options available from your system, your EMR, you need to be willing to consider altering your current processes to implement them. I encourage you to learn about system version updates when they get released and getting them into your live system, your live database as quickly as possible. The vendors are pushing out updates because they are providing ways to improve their system or to meet new regulations. And we as end users should integrate the new functionality into our routines. Improving the percentage of AR greater than 90 days can also be achieved by reviewing and optimizing your entire revenue cycle. Look at your revenue cycle as if you're an outsider and question, why are things being done in a certain way and whether or not it makes any sense? Why are there so many claims in the 90-day category? Why is so much money tied up in one payer? And why haven't statements been sent out in 3 months? If you doubt your ability to be objective, or maybe you find yourself in a I don't know what I don't know situation, that's where you can bring in revenue cycle experts like me or Paula to conduct an operational review, where we're going to come in and look at your entire revenue cycle from the very beginning, from the time that patient makes the first phone call into the practice, all the way through the registration, the front desk processes, collecting co-payments, the care that gets rendered, the documentation that goes along with that, the decisions of what codes are being used and modifiers, and then all of that happens in the back offices as well. When are we getting claims out the door? Why is it taking so long? When do we get payments? How long does it take us to post payments? When do we do follow-up? When does that account get to a zero balance? You want to look at the good, the bad, and the ugly, and to, have that outsider maybe make the recommendations and then help you with getting those enhancements made within your revenue cycle. Now, lastly, if you determine that for whatever reasons that keeping your revenue cycle duties in-house is just not a good option, you could outsource some or all of your revenue cycle duties. Perhaps an outsourced billing partner is going to be the best way for you to achieve your revenue cycle goals. Oh, looks like we have our next polling question. All right, so have you ever utilized an expert to conduct an assessment of your revenue cycle? Yes, no, I don't know. Right. So it looks like we have much higher on the no side. So that either means we have folks that are out there that have firecracker revenue cycles that everything is just churning and working like it's supposed to. Or there's a bunch of folks that didn't know that there was even an opportunity to have somebody come in and do that objective assessment for them. Who knows? All righty, let's go on then. So let's see, there are right and wrong ways of writing off a claim or an outstanding balance. Doing it the wrong way can result in unnecessary lost revenue or even in compliance concerns. Each account should be analyzed to determine if adjustments are actually contractual obligations or associated with coverage limitations, which maybe then could actually be appealable or transferable to patient obligation. Identifying patient financial hardship as a reason for write-off may also then require a different approach to be taken in order to be compliant. Documentation of the reason for a write-off is important from a compliance perspective, but also from a how might we prevent this from happening again perspective. Internal policies that outline the processes for handling various write-offs will ensure compliance with legal and ethical requirements. Timely review and processing of write-offs will help to minimize aged receivables and the potential for inaccurate billing and unnecessary statements. It will also then help with making sure that there's no unnecessary follow-up being done on account balances.
Andrea, before we move on to the next slide, there is a question in the chat box asking if using outsourced billing, would you still recommend an in-house manager or someone to be overseeing?
Absolutely. Yes.
I would say, so my perspective from an in-house manager, I don't know if you need somebody who's at a management level. You will need somebody that would oversee the outsourced billing company, but I don't know if you need a billing manager. Most outsourced billing agencies should be self-managing their staff, but you definitely need somebody who is a contact at the entity that would be a resource, because there are many things that an outsourced billing company still needs from the practice or entity, as far as like contact with the patient when they didn't give the correct insurance and things of that nature. So definitely still would need somebody in-house that could be that resource.
And I think like that liaison role that you said, Paula, where they're going to help to work between the two, because your billing service is going to find things that are operational issues at your practice or at your entity that you need to collaborate on. Otherwise, it's just going to keep spinning and spinning and nothing gets better. And it's really your billing service. It should be a partnership where you're working together to get the best revenue cycle outcomes. And the better it is, overall, the less work it is for your billing team as well.
And you should be, if you do outsource, that outsource billing company should look at themselves as an extension of your practice or entity. So they all should be one big team. And when you're looking at your KPI dashboard, they should be a part of that program, whether it's the denial management program or, reviewing that KPI dashboard and helping to understand, because, they are the individuals who are in the weeds doing the work.
Yeah.
Great question.
Great. Yeah. All right, so write-offs, they can be reduced through better medical coding and documentation, which are a common cause of write-offs. And additionally, since the longer a patient balance is outstanding, the greater the likelihood of never collecting that balance becomes. Having a comprehensive and effective policy on patient collections can go a long way in reducing your write-offs. Successful practices have a culture that support the collection of patient balances at the time of service or at least within 15 days of receiving a statement. Credit balances, they occur for many reasons, including front-end related issues like collecting co-payments when there really weren't supposed to be any collected. And on the back office side, there's issues such as failure to post payments or failure to post refunds in the system, not properly addressing insurance takebacks, not updating your pay or fee schedules in the billing system. All of those could create credit balances. Identifying the root cause of the credit balance is an important aspect of improving revenue cycle performance. Credit balances make the total aged receivable lower than it really is in reality, and that can create a false sense of comfort and make you think that your revenue cycle performance is better than it really is. Credit balances for all payers should be reviewed monthly. Governmental payers have strict guidelines associated with credit balances and overpayments. Many providers are required to complete and submit the CMS 838 Medicare Credit Balance Report on a quarterly basis. And by meeting this requirement, credits will be cleared from your AR on a regular basis. Medicaid overpayments, they must be returned and reported monthly as well. And that's now under the fairly new OMIG self-disclosure regulations. If you are unfamiliar with these, the OMIG self-disclosure processes, I encourage you to go to omig.ny.gov and then search for all of the information that's out there on self-disclosures. Strategies to improve patient statement processes include being willing to alter your statement cycle to get statements out the door as quickly as possible. Some providers may be able to get away from the once a month statements or sending statements out at, oh my goodness. You may be able to get away from those once a month statements or getting away from sending statements out based on like the starting letter of someone's last name, and A through L goes out on this day of the month and M through whatever goes out on a different day. Really, sending statements as soon as a private balance is identified is considered gold star. Not doable in every setting though. And then also sending second and third statements, at least at 30-day intervals, but ideally at 15-day intervals is also a metric you should consider. Processing statements in your office can be time consuming and may take precious time away from your staff that they just simply don't have. A mailing service may be a good option. The billing system and clearinghouses offer statement mailing services sometimes. And if you do use a service, you're going to want to make sure you have a reconciliation process in place that confirms the number of statements that you expected to get mailed out actually got mailed out. You could outsource all of your private pay functions, including statement generation and mailing, AR phone calls, and transferring accounts to collections. It's important to make sure that your statements are easy to read and clearly identify the amount due for each service, as well as that they provide enough information on them so the patient knows whether their insurance was billed and if a payment was received. Now, credit card on file is another option that can help to reduce statements. With credit card on file, a practice can use stored information to complete pre-authorized transactions, including automated recurring payment plans. And then lastly, offering multiple communication and payment options can help to reduce the number of statements that need to get sent. For example, e-statements. They include various digital communication tools, such as emailing, QR codes, interactive chat to pay, and SMS messaging. with an SMS message. Text messages are sent directly to patients' phones for billing purposes and then provide streamlined options for them to make payments. 2021 InstaMed report identified that 75% of patients want to enroll in healthcare e-statements, including 89% of customers younger than 40. Times are changing, and technology innovation is constantly expanding the options for streamlined patient billing processes. And you need to make sure that you're open to implementing some of these in your situation.
All right, so denials, if you didn't already know, are super expensive for a practice or entity. So monitoring, benchmarking, and root cause identification can reduce this cost for the practice or entity. Denials are my favorite KPI because I have a little bit of auditing and coding background. So to me, I look at these as denials are just about always preventable. If practices or entities are being proactive in addressing front end issues, if they ensure that their patient information is correct at pre registration and registration, if they're making certain that their charge master is up to date, which, if you didn't know, you should be reviewing that on an annual basis and making sure that correct charges are being utilized. Keeping in mind that CPT and HCPCS codes are updated on an annual basis, and there are many times that there are many codes that are added, deleted, and revised every single year. You want to make sure that you're confirming that your billing software and your claim edits are current. Clearinghouses and billing systems do make a lot of changes throughout the year, like Andrea said, and these claim edits are no different. You want to make sure that your staff are aware that they should not be ignoring any edit warnings, and they know who to turn to if they are aware or think they're aware, because sometimes they think they know what they know, but that they are aware or think they are aware that an edit warning is no longer valid before they just start to ignore that. Practice and entities should consistently be looking at ways to prevent, manage, and appeal denied claims. Again, you're going to hear me say this quite often throughout the presentation, as I always already have. Always determine the root cause of your denials and implement those processes to guarantee timely execution of your corrections to avoid additional claim delays. And lastly, utilize tracking tools to help you to identify what those root causes are. This here is an example on a way to categorize and monitor denials by provider. This will help you to keep track of your trends and allow communication within your core departments. These denial categories that you see here for referral, pre-authorization, untimely filing, not separately payable, coding, duplicate, these denial categories should always be modified based on the denials the practice or entity is receiving. No two entities are always alike. This is just another example of how you can track and trend. And if you didn't already know it, providers are pretty competitive. So if you track and put these charts in a visible area, they will ask the questions and want to assist with resolution for those things that impact them. If your practice or entity wants to maintain confidentiality, you can provide each provider with a unique identifier, so only they and the denial management core group would know which denials are associated to them. But this would still allow for that friendly competition and opening up the lines of communication. When I worked at a facility, quite a few years ago, but when I worked at a facility and I was overseeing the HIM department, we used to do something similar to this to our op notes and our signed completed notes. And you would be surprised how before these charts went up, we could barely hear from these physicians. But as soon as these charts went up and they knew who they were, even though nobody else knew who they were inside that HIM department doing their dictation and signing that documentation. All right, so poll number 2 that we asked about denial management programs showed that 38% of the people on this call did have a denial management program, but 62% of entities are without a denial management program, or they don't know if they have a denial management program. So those of you that fall in that 62%, it's now time to stop relaxing and pay attention. because again, putting together denial management program is so important. And we require a core group of members from all parts of the revenue cycle, including your registration team, your coding team, your clinical team, and your billing team. And as a group, that data should be analyzed for root causes. This group should also establish a denial management plan, which should include how to minimize and prevent future denials, ensure timely appeals, and create appeal letter templates, which will optimize your billing practices. Each entity should be completing regular audits of the entire revenue cycle. For example, looking at your coding, your claim scrubbing, your denials, your payment posting, your AR follow-up, including the quality, timeliness, and accuracy of billing notes being entered into your billing and claims ledger areas. Auditors look at that information when they're doing financial audits also. If you haven't conducted one, conduct yourself a baseline revenue cycle audit following the flow of 25 to 50 patients. Make sure that you are staying updated on payer-specific guidelines and policies, as this is important to avoid errors in claim submission. Entities should also be communicating with your payers on a regular basis, either a monthly or a quarterly standing meeting. And if it's an payer that you don't work with often, then just have that conversation with them if there's denials based on payer issues. Because we all know that the payers and their systems are not perfect, and sometimes it feels like we're fighting for our money. Lastly, whenever possible, make sure that the practice or entity is leveraging technology and data analytics. All right, so we're starting to run out of time, so I'm going to kind of skip around here a little bit to make sure that we have an opportunity for some questions. So this one here for your claim submission, your billing date, again, no KPI associated to it, but in order to make sure that you're improving your claim submission metric, you want to make sure that you're aware of payer timely filing limits, what's in your contract, make sure that you have procedures and workflows in place to collect accurate patient information, and that you're completing timely and accurate provider credentialing, which should be done at least 90 days prior to a provider starting with your practice or entity, not after they've already started with your practice. You want to institute a policy for ensuring timely completion of documentation, which includes escalations if providers are not consistently following. Timely charge entry and consistent billing cycles are also important, and having a policy to ensure proper claims follow-up protocols are followed, which should include following up according to proper payer payment schedule. You want to think about what is outlined in your billing policy, procedures, and workflows, and if they do not support best practice, consider revising to support achieving best practice. And if you don't have any, then you should probably put them together. All right, last poll here. Does your organization perform a soft or hard close monthly? Now I am going to, because we are on a limited time frame here, I'm going to keep going while you guys are answering those questions. All right, so our month end close. Again, we talked about this one does not have a KPI associated to it, but it is still super important to make sure that you're having a successful month end closing. So some strategies include developing a comprehensive checklist outlining all necessary tasks to complete that month end close. Perform account reconciliations throughout the month, not just at the end of the month, to identify discrepancies early and address them promptly versus having them snowball throughout the month. Before finalizing the month-end close, conduct a thorough review of all revenue cycle data, reconciliations, and adjustments to identify and resolve issues before closing the book. Practice or entity should encourage cross-functional team collaboration and open communication to ensure everyone is aligned on the closing process and can address challenges together. If you don't already have one, create a documented policy and procedure specifically addressing the month-end close process. You want to implement robust internal controls to mitigate fraud risks and ensure compliance. And of course, organize and properly file all your supporting documentation for transactions to facilitate audits and for future reference. Phew. Anyone else feeling like this guy right now? I know we've shared a lot of information with you, and I know we're just about out of time here. But in the event that you have any questions, feel free to put them in the chat box. You will see our contact information will come through on the slides when you receive them. Okay. As previously mentioned, those presentation materials will be sent to you within 2 weeks after the event ends. Should you have any inquiries, please do not hesitate to contact Andrea or myself directly, or contact your Bonadio Group representative. You can still register for upcoming sessions. The link has been shared in the chat. Look at that, she beat me again. And we do look forward to hosting you at future sessions this week. So give it just a couple of minutes. We are kind of out of time to look to see if there's any questions. Otherwise, we hope that you guys have an amazing rest of your day, and stay warm if you're here in New York, because we got a little bit of snow last night.
Take care. Bye-bye, everyone.